when you do new development, like it takes a long time by the time you put, you get it under contract and you identify it, and for you to like actually start even collecting rent on that.
Yeah.
So they say same thing with sports, right? Like you're not going to go in there the first day and like learn how to do a trick or like get your competition down. It's just a long time. There's going to be bad days, and there's going to be days you're discouraged, and like there's going to be days where it's cold out and the water's rough and it's cloudy and you don't feel like doing it, but you just have to do it anyways, you know? And so that kind of leads into the second part, which is just like trying to, there's a book called The Gap and the Gain by Dan Sullivan. I think it's Dan Sullivan. And I think it might even be co-authored with Benjamin Hardy. And it just talks about like, it's so easy to look at where we want to go, the horizon, right? And that's the gap. Like you're never going to close the gap between you and the horizon.
Yeah.
And so when and we always change the goalposts as entrepreneurs and as people. Yeah. But when you look back at how far you've come, that's called the gain. And you can see a physical mark. And so like you gotta, like at least for me, you have to celebrate those micro wins, you know, and like think like, because it's so easy to create these ambitious goals and to compare yourself to other people around you that are like at the top of their thing. You're looking at their Instagram highlight reels, right? You don't know what their life is really like, but you see these certain metrics that they use and it's like, I'm falling short. I got to be more like them. But it's like, if you just turn around and look at the gain, like how much progress you've made, maybe a year ago, 2 years ago, 10 years ago, like I have to do that to keep my sanity, because I get constantly lost in the, you know, this negative cycle of comparison otherwise.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
Austin, welcome to the show. How are you feeling today?
Hey, Peter. I'm doing great. Thanks for having me on. Excited to do the recording.
Awesome. Well, thanks for being here. Why don't we start with you introducing yourself to the audience?
Sure. Yeah. So my name's Austin, and I've been doing residential real estate since 2011. I was a professional wakeboarder for a long time, up until 2017, pretty much my whole life.
Say that again. You were a professional what?
Wakeboarder.
Oh, okay. Wakeboarder. Nice.
Yeah. Yeah. So traveled all around doing that. That kind of got me into the house hacking thing, and which is where you essentially, like I read Rich Dad Poor Dad, and I was wakeboarding and I was going to school. And that gave me the idea to essentially sign the master lease to a house and then rent out each bedroom individually, like with enough markup to pay for my rent so I could live for free. So I did that long enough to scrape up a down payment to eventually put on a house, which I did in April 2011, which was just the absolute bottom of the market. So got very lucky there. And then, you know, we can dive into as much detail as you want, but kept wakeboarding, ended up opening up some fitness centers as I was wakeboarding, retired from wakeboarding, you know, kept the house, ended up putting it on Airbnb while I was doing wakeboarding and the gyms. Ended up going all in on the gyms and working with Alex Hormozy when he had his program called Gym Launch. Sold those in 2019, right before COVID. And then my partner who helped me do site selection invited me to start working with him full-time in commercial real estate. So then we started doing site selection for healthcare practices and development for them as well. And then in the meantime, I kept my Airbnbs, acquired a couple more, and turned 2 of them into wedding venues. So that's the shortened and condensed version for the past couple years. When I did retire from wakeboarding, my wife and I also got into American Ninja Warrior. So that's been a fun journey too. So yeah, a million different ways we can go from there.
Yeah, there's a lot to dissect there. First and foremost, what is wakeboarding for somebody like myself? I'm a suburbs, a Philly guy, born and raised. Used to go to the Jersey Shore. Maybe I know it, but I don't know the name exactly. So explain that to me.
Yeah, it's just like snowboarding behind the boat.
Oh, okay. So I can picture that. Yeah, I didn't know if I knew that was called wakeboarding. Very nice.
Oh,
okay.
Yeah.
How'd you get into that? You're from Florida?
Yeah, we were living in Florida, and my mom was into skiing. We moved to South Carolina, but we got a place on the lake so that she could keep skiing. So I started skiing and barefooting and all that stuff really young. And then when I turned 12, I started wakeboarding, and I'm like, hey, this is way cooler than skiing. So I just focused really hard on doing that, and then moved to Orlando so that I could pursue it professionally, and then just went to UCF because that was the closest college there. I always said if I had to choose between wakeboarding and school, I'd choose wakeboarding. That's a very unique thing with limited time, but I never had to. So I was able to get I was able to graduate. It took 6.5 years because I traveled so much. But yeah, got it done.
What does the profession look like? Are you getting sponsorships and stuff like that? Like how does that work? How are you making money?
Yeah. So, we were just having this conversation the other day, but really it peaked like in the early 2000s. And so when I was looking at it, when I was getting into it, like these guys were on the X Games and, ESPN and major networks and like had a lot of, mainstream sponsors. But then X Games pulled out and the sport, like income wise, just kind of started to dwindle, even though like the participation was growing. So I kind of caught it on the tail end. But at the end of the day, look, you make great money for an 18-year-old,
Mm.
but it's not really a sustainable career. And so as I was getting older, I just kind of realized like, okay, yeah, this has been fun. This is awesome. I got to travel the world as like MVP to all these different places, but like, it's not really enough to retire on like
Sure.
NFL or anything like that. So you got to figure out what you're
Yeah.
going to do. And yeah, you make a lot of your money from sponsorships. I would say mostly there's competition money,
Okay.
but you've got to, there's travel and a lot of expenses involved and stuff like that. So yeah, it's like anything, top 10% make 90% of the money. So you just really try and be in that top 10%.
Yeah. Now, what is it look? Is it like a tournament? Like, are there races? Are there tricks? Like, what does that
It's
look?
tricks. Yeah, just like snowboarding. Yep.
Yeah.
So yeah, you just you do eight tricks. It's the best eight tricks, and you keep
Nice.
going. You keep up, qualifiers, quarterfinals, semifinals, finals, all the way till there's a winner.
Yeah. What did you like about that? Is there like an adrenaline rush from it, or like
Yeah,
what?
yeah, yeah. I loved jumping on a trampoline as a kid, doing flips, doing all that sort of thing. It was cool
Yeah.
watching the guys do that on the lake, and so yeah, it was
It's gotta
really
be
fun to go
exhilarating.
learn. Yeah, go and learn new tricks, like I mean it's scary trying something new and you take hard falls. And eventually that's why I retired is my body got old and my joints are hurting and all of these kids are have newer joints than me and so yeah, eventually it runs its course, right? Like I think that's why most people retire is their bodies just start hurting a lot.
Yeah, I can imagine hitting the water like that. It's like hitting concrete, right? It's
Yep, when you're going fast enough, it doesn't feel like water.
yeah, yeah, exactly. That's wild. So you did that for a while, and then you said you went to work for Alex Ramosi. Was that a kind of a direct hit there, or was there some things you did
So
in between?
So yeah, I opened up some fitness centers. It was a franchise called Nine Round, and we were growing. We were opening up new locations. So I had about three of them in Orlando that I was opening them up. As I was getting out of wakeboarding, I started to focus more. There was a little bit of an overlap there,
Okay.
because I was in health and fitness. Like I wanted to continue on in that. Alex Ramosi had just launched a gym launch. This was in 2017. And so we worked with him directly. We were doing everything he was telling us. It was working amazing. We got to see him. We went and we did the in-person events and all this kind of stuff. Everything he was saying was working really, really well.
Mm.
And I was ready.
In what way? Just like getting people out to the gym, or like how
Yeah, how to use Facebook marketing. The offer was like a free 6-week challenge, and then you ended up doing like they had to put down a deposit in order to do the challenge, and then you could get it back. So, it was a little bit like a bait and switch, which I kind of have mixed feelings about in hindsight, but like it was working. Group sales, the
Mm.
prices that you charge, accountability, the one-on-one training, the coach, like having a live person coaching you, that type of thing. I would say really like the sales and marketing was like the biggest piece and like how to run the Facebook ads, how to do a landing page, how much money to invest, how to create your own ad copies, how to do like how to automate it and schedule it, and then how to sell when you get in, right? That was like the big part. And then you could do whatever kind of workout you wanted to when you got in there. But it's all like very step by step formulaic. Hey, if you do this, it always came down to how much work can you put in, right?
Mm.
Like people aren't showing up. Well, how many times did you call them? Call them, you know,
Yeah.
like call them double, right? And so that whole sort of thing, like really teaching you how to work and like what's involved with actually putting in the work.
Yeah. Wow. God. So you did that for a little bit, and then were you buying real estate on the side there, or like how did
So my
that?
partner helped me do the site selection. So we did a competition analysis, a demographic analysis, and at the time I had three locations, was ready to do my fourth. And I thought to myself, hey, I want to go to Winter Park. That's like the cool, sexy area. And I want to stay away from Kissimmee because the demographics are kind of garbage. And he ran an analysis, my partner and his team, and they found out Winter Park is super saturated. It's full of competition and really high rents. And then Kissimmee is wide open. And we had no idea because I just realized you
Mm.
can't make good decisions without good data. So they gave me good data. And I was like, wow, this is really impressive. So I ended up getting in a disagreement with the franchisor. He ended up essentially banning all of Alex Ramosi's techniques because the franchisor had asked for a cut from Alex from all of his franchises, and Alex said, I'd rather not do that. So he said, like, nobody's allowed to do anything that he does. We're changing the operating agreement. So I was like, wow, I was ready to go. I was like about to sign my fourth lease and this happened. So I put them all up for sale. It took about a year, sold them right before COVID. So I was actually so thankful that the franchisor did that, because like if he had been a good person to work with,
Yeah.
I would have kept going, and I got hit by COVID, right?
Yeah.
So I'm really grateful for the way that everything worked out. Because I dodged that bullet, right? Like I saw the writing on the wall, and I listed them for sale, focused on getting the EBITDA as high as possible, sold them for a 3x multiple, which is not much. It's not a high multiple, but in the fitness space, a lot of these things close down or just sell for the price of equipment. So the fact that we were
Sure.
profitable, like, really helped us out.
Yeah.
And then yeah, my partner invited me to start working with him on real estate. So I knew the site selection component. He was already doing urgent cares and health cares and retail healthcare nationwide. So then we just started doing that. And the goal being, let's cast a wide net. We'll do a lot of brokerage. And then whenever something is available to buy, purchase, or develop, then, we'll do that for our clients. So that was kind of the genesis of it.
Yeah. And what was the gym model? Were you purchasing the locations, or were you leasing them? And then
I did.
how
Yeah, I started two. So I did the site selection myself. And again, this is how I knew that my partner's program was pretty cool, because I worked with a broker for both locations, the first two, and they were both just kind of like, yeah, that looks good. Sure. And like, we were doing a lot of our own research. Like, we're driving these areas a lot. Like there was no, like, he did not talk to us about competition. He did not talk to us about population density. He did not talk to us about income demographics. Like, you know what I mean? Like, it was just like, yeah, this is a busy area. This place is cool. Blah, blah, blah. This rent is it. Like, right. It was a very, very high level, if you will. So I acquired the third one for pennies on the dollar. The guy was just stressed. And that could have been a whole business model for sure. But I just got burnt out of dealing with it. I was working so much. So, when it came time to do the fourth location, again, that was when we did our demographic analysis, and I was planning on kind of opening up new ones and being opportunistic about which ones I could acquire. I put word out to all the guys in town that I wanted to acquire theirs. They were just unrealistic. Like, they weren't wanting to sell, right? So the price of that they were asking, they had to get beat up a little bit. Unfortunately, every single person that I sold to went out of business. They came in, they started to try to do their own things, and about, I think, like 9 out of the 10 in the greater Orlando area all went out of business. Wow. So just as sad. And don't quote me on that, but like, just a lot of people. It was, they have not, when you limit what they can do to sell, like, they weren't allowed to do stuff that was working from gym lunch.
Yeah.
Yeah, so it just made it was uphill battle, and then the COVID happened, just the perfect storm of everything. So just, unfortunately, not a lot of them survived after that.
Yeah.
But yeah, it was a combination, to answer your question, of startups and acquisitions.
Okay. So talk to me about the site selection business and where you're at now with it. So you're looking for primarily healthcare properties, or explain that to me.
Yeah, so we work with multi-site healthcare groups and dental, derm, behavioral health, vet, urgent care. Anything that's sub 10,000 square feet, really. But like, typically 2,500 to 5,500 square feet is our wheelhouse. And so the problem that we're facing today is really high inflation. And when it comes to healthcare in particular, they're capped at their reimbursement rates based on insurance or based on Medicare and Medicaid, which is regulated by the government. So you got a weird situation where the population base is growing, right? Your client base is growing because people are aging, they need more healthcare. Our population is still growing, even though the growth rates have slowed. And people just need to physically go into these places, like whether it's dental or urgent care or whatever. But they're getting extremely crowded. And so they're wanting to expand. But when real estate is up, inflation is at an high, which means cost of goods and land and interest rates and labor and all that kind of stuff is up high. It just makes the rent non-conducive. And so most developers only want to do single standing locations, which have the least economies of scale. So let's just pull out some random numbers. If you want to do a 2,500 square foot freestanding building, your rent's maybe $60 a square foot. If you want to do a multi-tenant building, you could drop that rent down to 45 a square foot. Just like, you know what I'm saying? Like, hypothetically, just because you're getting economies of scale. So what we kind of do is we'll take on the risk of doing a larger multi-tenant development, because we've been building relationships with large retailers my partner's been doing this for 15 years. I've been doing this for 5 years. So we have the confidence, like, we're doing it, like, there's a couple deals right now where our healthcare tenant just wanted one, like, I'll give you the one we're doing in the Orlando area. They wanted 4,000 square feet. Well, the pad could support 8,000.
Okay.
So we brought in, like the healthcare group gave us an assignment. We are developing an 8,000 square foot retail, like retail plaza, like small, I mean, small retail, but it is retail.
Yeah. Yeah.
And we have like 3 offers for the inline space, and then working with Panda for the in cap.
Nice.
And it's because we've done other deals with them, like
Okay.
out in different locations.
It must be a good
we've done-
location. Panda likes to be in good locations.
Oh yeah, and they like to buy the real estate. So yeah, it is definitely a testament to like, hey, this is this is like a good location. So yeah, like Panda, Starbucks, Chipotle, Chick-fil-A, those are all different AutoZone. Those are just some different retailers that we've worked with over the years. So like essentially, it's leveraging those relationships that give us the confidence to take on the risk of doing a multi-tenant development that we don't have all the spaces committed for before we like get the land under contract. So there's a lot of due diligence. The banks like to see at least half of the space leased up before they'll lend the money. So we got to have at least 2 out of the 3 tenants in this situation.
Yeah. And then a lot of times I'm assuming the healthcare, that's probably, like you said, 4,000 square feet. What's the typical range for them usually?
Each provider is different. So we have groups. I mean, people sometimes they want to do 1,500 square feet, which like we kind of stay away from those types of groups because it's really hard to develop for. But like I would say the minimum size is usually 2,500. Maximum we see is 5,500. So they're on the upper side, but of what we will see or work with. But it's about that.
Yeah. So a lot of times with them and then maybe another tenant or so, you have your 50% and you can get your financing in place and develop.
Yeah. So like for instance, if this facility only allowed up to call it 6,000 square feet, and we got a user for 4,000, then yeah, in this case we'd be able to get financing. Yeah, but because it's 8,000 square feet, the bank wants to see one more lease before we actually close on a loan, which is what we're working on right now. So I mean, we're not worried about it. Like I said, we have 3 offers that we can choose from. They're actually all franchisees, so we're just kind of picking which one we think has the strongest credit. But yeah, this is it's a strong deal. We utilize things like refinancing to really help increase the IRR.
Okay.
So I mean, when it comes to real estate, it's like it's a safe investment, right? Like it's not like I don't know what your listeners normally invest in or what they look at investing in, but I think a lot of times people might have an unrealistic expectation of how much they should return, because if you look at a venture capital deck, like a lot of times they're promoting high 20s, low 30% IRR, but of course, like it's because it's riskier, right? So the return,
especially on the development side, if you're thinking real estate world development, but for this, this is pretty risk averse. I mean, these are triple net, I'm assuming, right? I mean, the tenant's responsible for everything. And is the healthcare, is that usually a franchise or is that a corporate or?
No, we try not to use. I mean, if they had like a bunch of locations, we would do it. But like, yeah, franchise just doesn't have. If it's a single operator, they're just not gonna have good credit, So
yeah,
that's why the 3 offers that I mentioned earlier, we're kind of vetting them to see who has the strongest personal financials, and some of them have multiple locations, right? So that's going to be good. Like a 10-unit franchise operator will have pretty strong credit, like same as a 10-unit, call it dental operator, right? So,
yeah. Interesting. Yeah, no, I love this space, and I agree with you. I think people need to put things into perspective. It's with the triple net. What's the lease terms usually? Are they signing 20-year leases, or is it?
No, we do 10 with 5-year extensions. Yeah, so like 5-year 10% bumps. We push for like 2 or 3% bumps, but it's a balancing act because we have long-term relationships with these tenants. So it's like we don't want to put them in a position where they're going to be squeezed in 5 years, right?
Sure.
So like we'd rather make a little bit less money and have a client that we have a good relationship with that we can keep working with and do a lot of deals together, rather than maximizing one deal, right?
Yeah.
That's a little short-sighted on our part.
Sure. So are you guys developing to sell, or do you refi and hold, or a combination of both, or what's that look like?
We like to refi and hold. We're buy and hold. We call it the get rich slow scheme. You can flip, and yes, that will increase your IRR. So that's kind of like a battle that we face in explaining that to people, especially investors. Because if you're comparing IRRs, IRR does not count for the capital gains tax that you owe when you sell.
Sure.
And it does not account for the opportunity cost of where you put your money after you sell, right? So yes, we flip deals. It's this kind of ironic situation where your IRR does dwindle on paper, like the longer you hold it.
Yeah.
But to us, like it's just worth it to not to pay the capital gains tax. We can refinance, and yes, we owe interest on that money that we pull out, but we're pulling out a lot of cash that we can then reinvest as we see fit. And as long as we're using good tenants that have 10-year leases, we're confident that that extra debt service is going to be paid, right? That increased mortgage will be paid. So the cash flow does go down, but you're getting it's like reaching that future and pulling out a large chunk up front.
Yeah.
So to compare flipping to holding in that situation, you're not going to get as much cash from a refinance as you do from selling. But the two things that drive us to do that method is you don't owe taxes on the refinanced money,
Yeah.
and there's no opportunity cost. So you're going to have that equity continue to appreciate every time you have a rent bump, and you're going to continue to pay down the principal. So when we think about this over 10 or 20 years or longer, this seems to us like the safest way to build wealth for our families and our children.
Yeah, no, that's great. How do you usually structure deals with investors? Is it a fund? Is it individual syndication?
We've syndicated. We looked into doing a fund. We haven't done that yet. But historically, it's just been all syndications. And so, we're targeting 18 to 19% IRRs.
Okay.
And so we give the investors a preferred return up until like the refinance mark or a capital event, whatever. So refinance, capital event, whatever. And then we split everything after that. And so by doing the refinance, getting that money in the investors' pockets early, we do another one at the 5-year rent bump.
Okay.
So at that point, the goal is to have all their principal paid back.
Yeah.
Whatever cash flow they've collected along the way will be a bonus.
Yeah.
And then whatever, and then you still own your equity stake in the building, right? So year 5, you'll have collected a little bit of cash flow from rent. You'll have been paid back all of your equity in the first refinance, you get back a large chunk of it. In the second refinance, you get back the remainder of it. And now you still are going to you have like essentially phantom equity in the deal, indefinitely, as long as we hold it. So that's how we.
Oh, that's awesome. Yeah, and so you're already in a pretty risk-adverse investment to begin with the corporate tenants and real good franchise tenants and nice long leases with bumps put in and all that kind of stuff, and then you're refining, getting your principal back, so it's just putting you in a safer position there. I like that. I would think that would definitely make sense for certain types of investors. Talking about the site selection process. I mean, because I'm assuming these are redevelopments. Like, are you finding raw land?
It could be.
Okay.
Could be redevelopment. This one's ground up. The couple that we're doing one in Orlando and one in Portland, Oregon, like a clear opposite side of the country. But
so this is a national play for this.
We do it all over.
Okay.
Yep.
Great.
So we will do we've done a redevelopment in the first deal I did was in Lee's Summit, Missouri, 4 or 5 years ago. And it was an old Bank of America building that we bought and redeveloped for our client. That's a whole long story. But when we do a ground up development, or sorry, you asked about site selection, right?
Yeah. I'm just picturing a lot of times good retail like this. There's an existing property. Now it might have to come down probably most of the time to do what you're doing, but that's where I was just curious is, are you finding raw land, or is there typically a building on site that's vacant that you're taking down or redeveloping in some way? But just curious to what kind of locations that we're talking about here. It sounds like it's a main drag, in a good part of town, that kind of thing.
Yeah, so from a high level, essentially what we're doing is we're taking we'd run an analysis. We have different software. We pay for a subscription to a company called Pitney Bowes that allows us to use their data. And we find the most accurate data is from grocer anchors. So what we do is we run a grocer anchor study. Okay. So that's, we color coordinate them from like tier 1 to tier 4. So we'll overlay that on the map, and tier 1s we'll usually use as green just for this example. And then we do a study to find out where's the competition, and we overlay those on the map. So we're looking for where is the highest concentration of green grocer anchors and the least amount of competition. So from there, if something's available to lease, great. Like, we'll just lease it because that's a lot easier. We can just be the broker. But when nothing is available, which happens often, not super often, I would say it's really like 1 out of every 5 or 10 deals that we do, like 1 out of every 5 or 10 like sites that we identify is available to purchase or develop. Okay. But that's when we go in and just depending on what it is, like, so if we identify a particular corner and it's just an empty land, we'll just develop it. But if it's an existing building, we'll redevelop it. So we've done both. To answer your question.
Gotcha. Nice. God, how are you working on a national scale for that? You just explained how you're using data to find good locations, and then how are you working with brokers, just to be able to find, so that they're calling you, and not somebody else.
Well, that's the thing. We are brokers too. So we are like I'm identifying a big part of how I spend my time is trying to find these decision makers of these, multi-site healthcare groups. And so that involves like going to the events and networking. It involves we invite a lot of them on our podcast. The podcast is called Helping Healthcare Scale.
It's a little Alex Ramosi trick you're doing.
No, that was a Russell Brunson trick.
Oh yeah, is that because I've heard
Russell? Yeah,
talk about that. Okay.
he said, he's like, yeah, man. He's like, somebody invited me on their podcast, and I was like, yeah, sure. It's like I have no idea how big they were, how many followers they had. Like I just said, sweet, you got a platform? Oh, great, I'll do it. And I was like, huh, that's interesting. So yeah, back in 2020, we started the podcast, and sure enough, like people were really generous with their time and just happy to come on. And so it was really surprising. Like we got some of the really big name. We got guys that have like 700 locations, pop on.
Unbelievable.
We got the biggest dermatology group, the CEO, founder and CEO in the country. He's been on the podcast, like stuff like that. And then recently, Oren Klaff, he's a best-selling author for the book Pitch Anything.
Yeah.
Yeah. Yep. So, but yeah, look, anybody can do this. Like that's the playbook, right? So it's like they call it 7 degrees of touch. So it's like I invite them, find them on LinkedIn. I try and reach out to them that way. I invite them on the podcast, build a relationship for the podcast, find out how their business is working, and then follow up with them and then try and see them in person as much as possible. So if anybody's welcome to do it. That's what I've been working on for the past 4 or 5 years. That's the active part. We were talking earlier about active versus passive. Like that's the active part about finding off-market deals, right? So like anything in life, there's a trade-off between time and money. So nothing is really truly passive. Like the most passive investments, the most passive things you can do are being a limited partner in a real estate deal or investing in the S&P 500. But even that, you're going to be doing some research, right? And then like when you sell, there's an opportunity cost of where you're going to go next. But like anything else takes a little bit of time. Even like trading stocks, you got to do some research, like get a loan. It's like, I don't know, it's a pet peeve of mine when people say real estate is passive income. Like it is absolutely not passive income. I have a portfolio of short-term rentals. It is a full-time job. I mean, like it's a hospitality business.
Yeah.
You know what I mean?
Oh yeah.
We have VAs and cleaners and handymen and property managers. And like, I mean, there's a lot to it. So that's the route I chose to take because I just wanted that to be my business. But yeah, the only way to get it passive, like is to be a limited partner in a deal, right? Like, a lot of people, and I am a limited partner in deals too, right? And it's totally different. Like I don't know when the toilets break, and I don't know when you're like having to rebook. Like I've invested in short-term rental funds. I've invested in commercial like retail centers. Like I even invested in like a small bank here. But yeah, those are truly passive because I was a limited partner. But like otherwise, and it's just a decision I think you got to make for yourself. Like,
Sure.
What do I do right now? Like this is called the Accredited Investor Podcast. So probably if you're listening to this and you're accredited, you're making at least 200, if not more. So like, I think it's a decision do you think that you can make more money by stopping what you're doing to focus on real estate? And maybe the answer is yes.
Yeah.
Okay. And then, do it. But a lot of times the answer is going to be, well, if I focused, like there's dentists I know that focus strictly on implants that made $3 million a year with a single location, net take home,
Right.
Like, it's like, well, you probably want to keep doing this for a little while longer before you go and like focus on real estate. Right. So it's all different, right? For each person.
Yeah.
But it's a question you have to answer for yourself.
Oh, that actually brings up something I wanted to talk about. One other question. Does the healthcare companies that you're working with, do they typically have a pre-existing relationship with a broker and then you're working with them? Or okay, I would say.
Yep. Yeah. So we're the usurper, right? We got to come in and prove why we are more qualified to work with them. Now, what we have going for us is we will buy and develop. A lot of brokers don't develop.
Sure.
A lot of developers don't broker, so we're trying to marry those two things. So the deals are difficult to originate, but as a result, like we never really have like issues raising the money because the deals are so good. So when we find the deal, it's always pretty easy to raise the money for, because these are good tenants. Their SBA data says that dental has one of the lowest default rates out of all the different tenants, right? So we call it RPI, recession-resistant, pandemic-resistant, inflation-resistant. That's why we focus on healthcare, right? Because it's just so safe. And then like you talked about it earlier, you have a building, that's an asset. It's never going to go to zero, like the value of that. Like there's always going to be,
Especially if it's a good location.
yeah, that you can resell. So, yeah, yeah, those are the tenants that we focus on.
On the development side, how does that work? So if you're developing out of state or something like that, are you have a construction manager that works for you guys that goes and gets bids, or what does that part of the business look like?
Yeah, we've been working. I mean, my partner's done over 100 deal, like hundreds of deals with like some general contractors and
Mhm.
architects, and they would do everything in house. So like they're very specialized in healthcare.
Okay.
So we know that they're going to deliver on time. And that's a big deal, right? Like a lot of times we talk with people who want to use their buddy, and that's fine. Like if they're doing your build out or whatever, like, well, maybe I'll give you a better example. Like, well, in Oregon, the client that we were working with wanted us to use their architect. And he came back a little bit more expensive, and we let them know, hey, this is gonna bump rent a little bit because it's the rent is just a factor of the cost.
Mhm. Sure.
He said, yeah, that's fine. And these guys were so slow. And so it took
Mm.
much, much, much longer to get a response because we're trying to use his buddy. So
Yeah.
now moving forward, like we're very reluctant to use anybody that we don't know because their timelines are so important.
Yeah.
In this situation, not only were they more expensive, but they were slower. Most of the time, you can get a deal. Like, yeah, but it's like they run into issues they don't foresee because if you haven't done healthcare specific build outs, I mean, you don't know the exact plumbing requirements and the exact electric requirements, and like the more deals you do, the more of that specific type of use case, the better you get at managing
Sure.
your timelines.
Yeah. No, that makes a lot of sense. To go back to some of the stuff we were talking about, how is just the mindset of the business for you, and how is what you've done in the past, with on the athletic side and through gyms and things like that? You mean, how is that? What approach do you take to mindset around investing?
Yeah, so there's a couple things there. I think number one is the sense of delayed gratification. And
Mhm.
so, I mean, it takes a long time when you do new development, like it takes a long time by the time uh you get it under contract and you identify it and um and for you to like actually start even collecting rent on that.
Yeah.
So they say with same thing with sports, right? Like you're not going to go in there the first day and like learn how to do the trick or like get your competition
Sure.
down. It just
Start
takes a lot of
winning
time.
competitions.
There's gonna be bad days, and there's gonna be days you're discouraged, and like there's gonna be days where it's cold out and the water's rough and it's cloudy and you don't feel like doing it, but you just have to do it anyways.
Mhm.
And so that kind of leads into the second part, which is just like trying to. There's a book called The Gap and the Gain by Dan Sullivan. I think it's Dan Sullivan, and I think it might even be co-authored with Benjamin Hardy. And it just talks about like it's so easy to look at where we want to go, the horizon, right? And that's
Mhm.
the gap. Like you're never going to close the
Mm.
gap between you and the horizon.
Yeah.
And so and we always change the goalposts as entrepreneurs and as people.
Yeah.
But when you look back at how far you've come, that's called the gain, and you can see a physical mark. And so like you gotta like at least for me, you have to celebrate those micro wins, and like think like because it's so easy to create these ambitious goals and to compare yourself to other people around you that are like at the top of their thing. You're looking at their Instagram highlight reels, right? You don't know what their life is really like, but you see these certain metrics that they use, and it's like, I'm
Sure.
falling short. I got to be more like them. But it's like if you just turn around and look at the gain, like how much progress you've made, maybe a year ago, 2 years ago, 10 years ago, like I have to do that to keep my sanity because I get
Yeah.
constantly lost in this negative cycle of comparison otherwise. So I don't know
Sure.
if that answers your
Oh,
question.
100%. Yeah. I mean, you can't take the little wins for granted. That it all kind of compounds into the greater picture. And what would you say your kind of long term goal is here? I'm assuming you want to build this portfolio up, and then, what do you do from there?
Yeah, me and my partner's goal long term is to own like 100 buildings. So I don't know. What does that mean? Like, it means we have to do a lot more transactions than that because we don't hold everything.
Mhm.
But like, I mean, we do want to build a portfolio that we don't really have to sell. That
Mhm.
we can just keep for a long time. So like the deals that are in areas that we don't have as high confidence in the market, we'll probably flip those. For
Mhm.
the most part, like if they're in good areas, we're just gonna try and hold them because as people go and migrate to these areas and the cost of real estate continues to go up just due to the simple factors of inflation. Like, yeah, maybe it goes up and down a little bit over the short term, but like long term, like even at 2% inflation, it's going to be worth a lot, right? If you wait long enough. So that's just kind of our thing is, yes, we'll sell, but for the most part, we're just trying to hold and, again, create like this. I don't know. I don't like the word generational wealth, but I mean, that is kind of the goal of holding on to these assets as long as possible.
Yeah. That's awesome. So how would people find out more about what you're doing, Austin? How could they get involved?
Yeah, check me out on LinkedIn. So Austin, like the city, hair like on your head. Yeah, happy to give advice if you want to get into real estate. Like if you just want to look at our deals that we have going on, happy to share those too. Like I said, we're not capital constrained, so we don't need the money, but we'd be happy to talk with anybody about it.
Awesome. Well, thank you so much for being here today and talking about this. This is a very exciting topic that I think probably not a lot of people in the real estate space know a whole lot about. And if you do, then you're probably doing it in some way because it's a good place to be, and it provides great diversification from the residential side and multifamily world and that kind of thing. So I appreciate you coming on and talking to me. Go for it.
Yeah, and to your point about residential, like I don't want to make it seem like an either or thing, right? Like I think there's certain niches, but the fundamentals, I'm pretty hooked on the fundamentals of real estate. Like when it comes to, do we think that the Fed and the government are ever going to stop completely printing money, right? Like absolutely unequivocally no. How much they print, it can be up for debate. But what happens when the money supply increases is you have asset inflation. So whether it's a little bit in the short term and inflation comes down, like inflation will never be zero, and therefore, like you gotta, in my opinion, invest in something. And I think real estate is just like it's such a stable. Listen, I invest in stocks too. Okay, I like that, but like they're just different. The real estate provides that safe, simple, stable kind of asset. And so like even like the short term rentals that we do, like in the wedding venues that we do, yeah, those are technically residential, but they still provide a good income stream by rent. Doing the events fees and doing the luxury rentals and stuff like that. So yeah, I guess the point is like for me, no matter what type of real estate it is, like I'm pretty bullish. All things considered, residential, commercial, retail, maybe not office right now, but again, it's so beat up right now. Can you really see it going lower? So I don't know, but yeah,
Depends, that's office. I think is a very micro asset class. The
it is.
macros aren't in the favor right now, but from a micro perspective, there's locations where it's just you're gonna have no vacancy at all. You know what I mean? Especially those smaller kind of offices like we have. I'm thinking of a few around here where like it's just smaller suites. It's just they are never vacant. And now the other ones that are large are like football fields almost. It's a little bit of a different story, but
Yeah.
I completely agree with you from the real estate perspective. It's a smart place to be in for a number of different reasons, especially right now. But I like the commercial aspect to it, and this has been a space that's always interests me, especially on the retail side with what you're doing. So I appreciate you coming on and talking to us about it, and I wish you all the best of luck in the future here.
Yeah. Thanks, Peter.
Thanks, Austin.